You know that feeling when you realize you've been playing a game you didn't know you were in? That's what happened to me 3 months ago when I noticed something strange in my own bank statements. I was earning more than last year, spending roughly the same, and somehow ending up with less. Not a little less, meaningfully less. I started asking friends, same story. Colleagues, same story. Then I started looking at the data, and that's when it clicked. We're all living through something that doesn't have a name yet, but it probably should. Because it's not a recession, it's not a boom. It's something weirder, something more deliberate. It's a coordinated financial bulk and cut cycle, and most people are cutting while they think they're bulking. Let me show you what I mean. In bodybuilding, the bulk and cut strategy is simple. You bulk by eating more calories than you burn, accepting some fat gain to maximize muscle growth. Then you cut by eating less, burning fat while trying to preserve that muscle. The key is knowing which phase you're in, because if you think you're bulking but you're actually cutting, you just starve. If you think you're cutting but you're actually bulking, you just get fat. The same cycle exists in finance, except instead of muscle and fat, it's wealth and debt. And instead of you controlling the phases, someone else does. Here's how it works in the real economy. During a financial bulk phase, cheap money floods the system. Interest rates drop, credit becomes easy, asset prices rise. Everyone feels richer, even if their income hasn't changed, because their house is worth more, their portfolio is up, their business has higher paper valuation. The system is designed to encourage you to borrow and spend. This is when debt feels smart. This is when leverage feels safe. Then comes the cut. Interest rates rise, credit tightens, asset prices stall or drop. Suddenly, the same debt that felt strategic now feels suffocating. The wealth you thought you had evaporates because it was never really yours, it was just inflated value in a low-rate environment. And here's the cruel part. Your debt stays exactly the same size. Actually, it gets more expensive to service. You're forced to cut spending, sell assets, tighten everything, not because you want to, because you have to. The people who win this game are the ones who bulk during the bulk phase and cut during the cut phase. They borrow cheap, buy assets, then lock in gains and reduce exposure before the cycle flips. The people who lose are the ones out of sync. They cut during the bulk by staying cautious, missing the run-up in asset prices. Then they bulk during the cut by taking on debt right as rates rise and values fall. Most people are in the second group, and they don't even realize it. Let's trace this cycle through the last 15 years, because that's when the pattern becomes impossible to ignore. 2008, financial crisis. The system nearly collapses. Central banks panic and cut interest rates to basically zero. This is the start of the longest bulk phase in modern history. For over a decade, money is almost free. Stocks go up, real estate goes up, startups raise money at insane valuations. If you owned assets, any assets, you got richer. If you didn't, you fell further behind, even if your salary technically increased. By 2019, the gap between asset owners and non-owners is a canyon, but most people don't see it that way. They just see houses they can't afford and portfolios they're not part of. Then 2020, pandemic. The bulk phase goes into overdrive. Governments inject trillions. Central banks buy everything. Stimulus checks, loan forgiveness, rent moratoriums. It's a sugar high. People who never invested suddenly become day traders. Meme stocks, crypto, NFTs. Everyone thinks they're bulking. Everyone thinks they're getting in. But here's what they missed.
The actual bulk phase, the one where smart money accumulates real assets at low cost, that already happened between 2008 and 2019. What's happening in 2020 and 2021 isn't the bulk. It's the end of the bulk. It's the part where valuations go parabolic and retail investors rush in right before the music stops. Then 2022 arrives, inflation spikes, central banks reverse course, interest rates start climbing faster than they have in decades. The cut begins, and it's vicious. Stocks drop, bonds drop, crypto collapses, real estate stalls, tech companies lay off thousands, startups die. Suddenly, everyone who borrowed cheap to buy expensive things is stuck. Their assets are worth less, their debt costs more, they're underwater and they don't even know how they got there.
Now it's 2026. Rates have been high for a while. Inflation has cooled but hasn't disappeared. The economy isn't collapsing, but it's not growing either. It's grinding. And here's the question nobody's answering clearly. Which phase are we in now? Are we still cutting? Are we about to bulk again? Or are we in some weird in-between state where different parts of the economy are in different phases? Because that's what it feels like. The stock market thinks we're bulking. It's near all-time highs, but consumer sentiment thinks we're cutting. Credit card debt is at record levels. Savings rates are down. Delinquencies are up. Housing feels frozen. People can't afford to buy, but they also can't afford to sell because they locked in low rates, and moving means taking on a new mortgage at double the cost. It's financial schizophrenia. Here's the uncomfortable math that makes this whole thing so disorienting. Let's say you bought a house in 2020 for $500,000 with a 3% mortgage. Your monthly payment is around $2,000. That house is now worth, let's say, $600,000. You feel like you're winning. You have $100,000 in equity, but you're not liquid. You can't spend equity unless you sell or borrow against it. And if you borrow against it now, that home equity line of credit isn't 3% anymore. It's 8 or 9. So your wealth is trapped. Now imagine you didn't buy in 2020. You're trying to buy that same house now. It's listed at $600,000, but your mortgage rate isn't 3%. It's 7%. Your monthly payment isn't $2,000, it's $4,000. You need almost double the income to qualify for the same house. Same asset, same market, completely different financial realities depending on when you entered. This is the hidden mechanism. Timing isn't just important, it's everything. And most people don't control their timing. Life controls it. You buy a house when you need a house. You take a job when you need a job. You invest when you finally have money to invest, which usually means you're late. The people who win aren't smarter, they're just synchronized. They had capital during the bulk and discipline during the cut. Let's talk about who's actually bulking right now, because it's not who you think. Private equity is bulking. They raised record amounts of dry powder during the high rate environment, and now they're sitting on over $2 trillion waiting to deploy. They're not buying yet. They're waiting for distress, waiting for defaults, waiting for forced sellers. When rates finally drop or assets drop enough, they'll go on a buying spree. Sovereign wealth funds are bulking. They're buying ports, infrastructure, energy grids, real assets, things that generate cash flow regardless of interest rates. Wealthy individuals are bulking, not in stocks, in private credit, private real estate deals, direct investments, things normal people don't have access to. Meanwhile, the average person is cutting. They're paying down credit cards, delaying purchases, skipping vacations, stretching budgets, and they think they're being responsible. They are, but they're also missing the accumulation phase happening in parallel in markets they can't see. This is the paradox. Cutting is the right move when you're over-leveraged, but if everyone cuts at the same time and you're not positioned to bulk when things bottom, you just end up poorer in relative terms, even if you did everything right. Now let's zoom out, because this isn't just about individual decisions. This is structural. The bulk and cut cycle used to be somewhat organic. Economies would overheat, central banks would cool them, then they'd stimulate again. The cycles were shorter, more predictable. You could kind of feel where you were. But something changed after 2008. The cycles got longer and more extreme. The bulk phase lasted over a decade. The cut phase has been sharp and punishing, and the swings in asset prices have become so violent that entire generations are getting priced out of wealth building. If you're 35 right now, you missed the post-crisis real estate bottom. You missed the longest bull market in history unless you were already invested. You graduated into weak job markets or took on student debt at the worst time. And now you're trying to start building wealth in an environment where everything costs more and returns are uncertain. If you're 55, you probably did okay. You bought a house when they were affordable, you invested when valuations were reasonable. You benefited from the bulk without even knowing it was a bulk. This isn't about blame, it's about structure.
The system is creating winners and losers based on birth year and entry timing more than effort or intelligence. And here's the darker part. The system knows this. Policymakers know this. They just can't fix it without breaking something else. If they cut rates to make housing affordable, they risk reigniting inflation. If they keep rates high to control inflation, they crush growth and lock out new buyers. If they let asset prices fall to reset affordability, they destroy the wealth of everyone who already owns, and those people vote. So they're stuck. We're stuck in a cycle that nobody fully controls, and everyone is trying to navigate blind. There's a quote I keep coming back to. The market can remain irrational longer than you can remain solvent. It's usually applied to trading, but it works here too. You can be right about the direction of the economy and still lose if your timing is off. You can save responsibly, avoid debt, live within your means, and still fall behind if you're not in the asset accumulation phase during the right phase.
And that's the part that feels rigged, because it kind of is. Not in a conspiracy theory way, in a structural design way. The system rewards people who have capital when capital is cheap, and punishes people who need capital when it's expensive. It's a timing-based wealth transfer mechanism, and it runs on a cycle most people don't see until it's too late. So, which phase are we in right now? Honestly, I don't think anyone knows for sure. We're probably late cut, early transition. The economy hasn't broken, but it's strained. Inflation is down, but not gone. Rates are high, but maybe plateauing. Some assets are expensive, others are cheap. It depends where you look. What I do know is this. If you're waiting for a clear signal, you'll miss it. The bulk phase doesn't announce itself. It starts quietly in the wreckage of the cut. By the time it's obvious, it's over. And the cut doesn't ring a bell either. It just tightens slowly until something snaps. The people who navigate this well aren't the ones with the best forecasts. They're the ones with the most options. Cash to deploy when things are cheap. Low fixed costs so they can survive when things are expensive. Flexibility to move when opportunities appear. Everyone else is just along for the ride. Here's the thought I'll leave you with. We talk about financial literacy like it's about budgeting and compound interest. And sure, that matters. But the real literacy, the one that actually determines outcomes, is cycle literacy. Knowing where you are in the bulk and cut. Knowing when to take risk and when to reduce it. Knowing that the game isn't about being smart, it's about being synchronized. And right now, most people are out of sync. They're cutting their spending while assets are being accumulated by those who can afford to wait. They're scared of debt while the wealthy are locking in long-term, low-cost financing before the next bulk wave. They're watching their purchasing power erode in real time and blaming themselves for not working harder, when the real issue is they're in the wrong phase doing the wrong thing. You can't bulk and cut at the same time. You can't save your way to wealth in an inflationary environment. You can't spend your way to stability in a high-rate world. You have to pick. And to pick correctly, you have to know which phase you're in. So ask yourself, are you bulking or cutting? And more importantly, are you doing it on purpose or is it just happening to you?